global oil supply just collapsed by 10 million barrels a day. Inflation is roaring back, and the Federal Reserve is officially trapped. Welcome to the 2026 stagflation shock. We're stepping into this wild, unpredictable, no-rules world right now, where all the traditional economic playbooks, they're being thrown right out the window. In this explainer, we're going to break down how massive geopolitical choke points are suddenly dictating whether our modern, tech-driven economy can actually survive. To really wrap your head around the sheer scale of a 10.1 million drop, think about it like this. That is roughly equivalent to wiping out the entire daily oil consumption of the European Union, literally overnight. With OPEC Plus production basically falling off a cliff, we are suddenly staring down a total global supply of just 97 million barrels a day. The market hasn't just been disrupted, it has been completely turned upside down. And the immediate fallout? Well, you know that brief little window late last year where prices at the grocery store and the gas pump actually felt like they were stabilizing? That disinflationary calm is totally gone. Inflation is roaring back. Because look, when energy markets face a physical disruption of this magnitude, the cost to transport literally every single good you buy spikes. The International Monetary Fund has already been forced to severely revise their headline inflation projections upward to 4.4%. Which brings us to the ultimate macroeconomic nightmare. The Federal Reserve is officially trapped. They're stuck at a brutal crossroad right now. Normally, higher inflation means you raise interest rates to cool things down, right? But a slowing, deeply disrupted economy desperately needs them to lower rates just to survive. It is your classic high inflation, low growth combo, stagflation, and it's threatening to drag down both stock and bond prices across the globe. Quick note before we get deeper. The following analysis is for informational purposes only and does not constitute financial advice. Always consult a certified fiduciary before making investment decisions. All right, let's dive into Section 1, the $130 oil crisis. The effective closure of the Strait of Hormuz following Operation Epic Fury has essentially choked off global oil flows. Tanker traffic in one of the world's absolute most critical maritime choke points has collapsed by 70%. And because it can't be safely exported, we're seeing floating storage in the Middle East Gulf surge by 100 million barrels. That is oil the world desperately needs, just sitting out there on the water. The underlying geopolitical architecture is facing its most severe stress test since the mid-20th century. What started out as a shadow war and then escalated through the June 2025 12-day war has now culminated in a massive regime shift. The fundamental rules of how energy is traded have permanently changed. This isn't just a temporary geopolitical flashpoint. It's a structural transformation forcing massive refining cuts worldwide. The result of this unprecedented supply destruction is Brent crude skyrocketing to a spot price of $130 per barrel in April 2026. What's crucial to understand here is that the market has entered what's called extreme backwardation. In plain English, immediate delivery of physical barrels is so constrained that buyers are willing to pay a massive scarcity premium just to get oil today. It is completely outstripping future prices. If you want to survive this macro shift before retail catches on, hit subscribe right now. Our data is always 2 steps ahead. Moving on to Section 2, the systemic bifurcation. We are tracking a structural divergence right now that is completely unprecedented in economic history. On one side, advanced economies are pouring trillions into a digital, technological AI boom. But on the flip side, this infinite digital ambition is violently colliding with a very finite physical world resource crisis. It is the AI capex boom fighting an unrelenting physical energy shock, playing out in real time. This brings us to the AI compute contest, which is suddenly hitting a brick wall of physical constraints. AI data centers are absolute power gluttons, requiring a staggering 30% annual power growth. These facilities are now fighting for limited energy in a world where oil is incredibly scarce and expensive. If non-megacap tech companies can't afford the sky-high energy bills required to power their infrastructure, those 14 to 16% EPS growth margins will vanish. And that puts massive pressure on the tech valuations sitting right in your 401k. Let's transition to Section 3, the Fed's impossible dilemma. This is where the trap really snaps shut. Looking at the data for April 2026, the Federal Reserve is stuck in a hawkish hold. They're keeping interest rates painfully high at 3.50% to 3.75%, trying to kill off sticky inflation, with core PCE sitting at 2.7%. But simultaneously, people are losing jobs. Unemployment is taking up to 4.3%. So what do? Do you cut rates to save those jobs, or do you hold them high to crush $130 oil inflation? This polycrisis has essentially fractured the Fed from the inside out. We're seeing the Myron descent, where Governor Stephen Myron has openly pushed to cut rates to save jobs and keep businesses growing. Yet, to avoid a total market panic, the central bank is quietly executing stealth quantitative easing. They aren't officially lowering rates, but they are secretly pumping money back into the system by reinvesting proceeds from maturing bonds just to keep the plumbing of the financial markets working. So how are the big players handling this? Let's check out Section 4, Institutional Asymmetric Hedges. When we look at the April 2026 data, the projections from smart money institutions are frankly staggering. They are building massive structural bases in commodities to escape counterparty risk. Gold is sitting at $4,668 an ounce, with JP Morgan targeting an astonishing $6,300. Silver has surged over $74, with bullish targets pushing past $118. The era of easy, frictionless supply, that's dead. We have officially entered an era of structural scarcity. And notice how silver is effectively breaking out of gold's shadow entirely here. Why? Because you simply cannot build the AI and electrification boom without it. Immense amounts of physical silver are required for hardware, solar panels, and EVs. This inelastic demand, projected at 650 million ounces just for industrial fabrication, is colliding head-on with a 6-year structural mining deficit. The physical market is breaking, and that's exactly why prices are up roughly 140% year over year. Simultaneously, we're witnessing a massive rotation in commercial real estate. While traditional office buildings sit empty, collapsing under high interest rates, capital is aggressively flowing into specialized subsectors. Data center REITs own the physical buildings that house the massive server farms. They have absolute inelastic demand from AI giants who simply must have space. They are the physical landlords of the digital boom, making them a premier safe haven right now. So how do you hedge an AI bubble colliding with an energy crisis? The institutions are quietly hoarding physical silver and data center REITs. That is the ultimate asymmetric play for 2026. Watch our full breakdown on the silver squeeze matrix right here. Stay analytical, stay safe. But ask yourself, if the institutions are quietly hoarding all the physical assets required for the future, what happens to the retail investors left holding nothing but digits on a screen?